right, we'll go ahead and get started. Good morning. I just wanted to thank you all for joining us on our next virtual conversation. Today, we will cover and summarize the 2020 CARES Act for small businesses. A few housekeeping tips for today. We'll be recording this session and we can share a link with you once the event is complete. Welcome you to revisit the content and share it with any of your colleagues. We hope this information will help you during this really tough time. The slides, we are also doing an ebook, and we'll share it with you here so you could follow us along in the chat room. If you'd like to go ahead and take a look at that, we'll be going over the program, and we'll also, you can keep this ebook for yourself for reference for later. For now, if you can mute your phones. We would like for you guys to ask questions, but feel free to ask it in the chat box or raise your hand. We're more than happy to hear your questions throughout the entire webinar. And at the end, we're going to have a session for Q&As that come up during this talk. So I'd like to introduce myself. My name is Peony, and I'm one of the catering specialists here at Eatgeek. If you haven't already heard of us, we are a Bay Area-based platform that partners with the top food trucks, caterers, and restaurants who can provide dependable delivery, exceptional service, and world-class food. And we help customers plan their catering events. I have also helped build Eatgeek's 15,000 follower base on social media, and I manage all of our social media here at Eatgeek. And today I have the pleasure of introducing our CEO and co-founder of Eatgeek, Collin Wallace. Welcome, Collin.
Hey guys, how's it going? Everybody's getting acclimated to the sort of the new norm of being remote from everyone.
Yeah,
it's quite a change.
It's pretty different,
Yeah.
Especially when we're all so used to being social and going out to restaurants and seeing the faces of our partners every day. It's a little bit different to only hear people over the phone.
Yeah, totally. Well, look, if there are any like technology challenges, let us know. I think we're still getting acclimated to the process of sort of putting together webinars and sort of interfacing with people this way. Just a quick intro for myself. Like Peony said, my name's Collin Wallace. I'm the CEO for Eatgeek and the co-founder as well. We've also got my other co-founder, Ashutosh Joshi, who's I think he's on. Yeah, he's on. And you know, we set out to build Eatgeek to basically level the playing field for restaurants and for food trucks. Our background, both of us are engineers. We started a company before that became what's now Grubhub, or part of what's now Grubhub. And we left and said, like, let's do it again in a way that's going to make sure that the power stays with restaurants and stays with the people who are important to us and helped us build, you know, Grubhub in the first place. And so we've been building a lot of tools and trying to put out information that's going to help restaurants to, you know, keep themselves in power and control of their own destiny. And in light of what's going on with coronavirus, you know, we wanted to make sure that our partners and that restaurants in general had the information they needed to make good decisions about their financing, their personal and business decisions going forward. And so this is, you know, one step or one example, you know, in a long series that we're putting together on, you know, how to take advantage of the opportunities that are there and how to protect yourself against some of the challenges that we're going to face during this coronavirus. This specific talk is going to be about the payroll protection program, which is part of the CARES Act. So what we did is we put together an ebook that gives you the outlines of what's in the bill. Most people probably haven't read it. It's over 800 pages. We spent most of the weekend going through it and trying to pull out the information that was relevant to our restaurant partners and to other small businesses. There's a lot in there that's, you know, relevant to Boeing and, you know, companies like that, but we're not going to, you know, cover those things. It's just not relevant for us, I think, right now. So with that being said, let me just share my screen here. Let's see here, if one is correct. Okay. Is everybody able to see this? It should say, you know, 2020 CARES Act.
Yep.
Sounds
can
like it.
see it.
Okay, great, perfect. Okay, so just a little bit of housekeeping to Peony's point. Uh, we've got a lot of experience in this space, but the climate's changing very, very rapidly. And so this material, it's really intended to be a guide for you. We're not the lawyers, we're not CPAs. And so I think for the more in-depth questions you may have, it's going to make a lot of sense for you to consult with your tax or legal, advisors to get really definitive answers on those things. So we're not giving legal advice, we're not giving accounting advice along those lines, which are simply just trying to provide a guide on best practices that what we've seen and sort of summarize what's in the bill. Okay, so topics that we're going to cover: the program itself, like what does it entail, who's eligible, what are some of the rules that you need to be careful of, specifically for restaurants, and then sort of maximum loan amounts, different deductions that you're going to be able to take, and sort of loan forgiveness associated with that program, terms that you want to be aware of in terms of how the loan is going to be distributed and what you're responsible for, and then also understanding how it impacts or interacts, with other parts of the CARE Act. That's going to be important as well to understand. And then a couple of thoughts on what you might want to do as a business, and some important tips for applying. The link for this ebook is in the chat window, so feel free to download it. We also created a calculator that's going to let you see more or less what you're eligible for as far as the program is concerned, the amount that you're going to be able to borrow there. And so feel free to use that. Feel free to share it. It should make your life a little bit easier. We also added some links in the ebook to different calculators for Gusto and for Rippling, some of the more popular payroll providers, so that you can use those calculations as well. Okay, so overview of the paycheck protection program, the payroll protection program. So as you guys may have heard about, right, the program was signed into law March 27th of this year. It was literally the largest economic stimulus package our country has ever delivered, $2.2 trillion, which sounds like a lot of money. In the grand scheme, it's about 7% of our annual economy. So typically, you see between 20 and 22 trillion dollars a year is what our GDP typically comes out to. So it's a pretty substantive bill. Out of that $2.2 trillion, 349 billion of it was allocated for small businesses in the form of this PPP program, right? It's what it's colloquially called. Now, the SBA, or the Small Business Association or Administration, has had a program in place to create loans for small businesses and restaurants and other businesses like that for quite some time. And that's typically been called the 7A program. Some of you may have used that program before. Typically what happens is an individual goes to the SBA, they say, hey, I'd like to start a restaurant. The SBA looks at their home, looks at their cars and other creditworthiness things, and they will lend money to this business owner to get their business started. And that loan is backed by or guaranteed by the US government under certain conditions, right? And this is traditionally called the 7A program. The stimulus bill here, or the CARES Act, is basically being deployed through the same mechanism, right? So it's being administered by the Small Business Administration. It's under a different program than 7A. It's under the PPP program. But many of the process for, much of the process for getting those loans is the same or similar to what you find in the 7A program. Okay, so under the program, the cap is basically $10 million for PPP. So business is not going to be able to borrow more than $10 million. The logic is basically, if you need more money than that, you're probably not a small business, right? And so that's why some of those stipulations are in place, and we'll talk a little bit about how that's going to be calculated. So there's over 1,800 institutions that are 7A participating lenders. Now, what's actually happened is a number of new lenders have actually come online to be able to help administer these loans because the demand was so high. To put it in perspective, I think Bank of America opened up their application Saturday morning or Saturday afternoon. Within the first hour, they had 85,000 applications to the program. To put that in perspective, the SBA typically does about 60,000 loans per year. So you can imagine sort of doing 85,000 in 1 hour. The estimates roughly that there will be between 1.75 and 2 million applications for the PPP program. Now, the other part of this is it's a first come, first served basis. So in many cases, if you kind of wait to apply for the program, there is some possibility that there won't be funds there. So as of yesterday morning, about 55 billion of the capital was deployed out of the 349 billion. So my estimate is that like probably by Friday or Saturday, you'll see this fund depleted. Now the Treasury they've at least signaled that they're going to do another infusion of 250 billion. But this is definitely something I wouldn't wait on, right? So I think you want to get to the front of the line and get your application in there. If you're approved and you decide that you don't want to take the cash in the end, or you take the loan for a few weeks and prepay it, there is no prepayment penalty. So I think our general advice is it's better to have the cash and not need it than to not be able to access it later on. I don't know if there are any questions on that. I'm happy to take those now, or actually, if I can see the chat window. Yeah, just let me know if they come up in the chat window, because I actually can't see it while I'm sharing screens here. So, okay, talking about eligible borrowers and what's the standards there. So your company needs to have less than 500 employees, and your business needs to have effectively been started prior to February 15 of 2020, right? So February 15 of this year. You need to be independently owned and operated, right? So, and also not dominant in your field. What that means is basically you can't be McDonald's and say, oh, we need help when you're a super dominant player in your industry. The other piece of this is that people who operate as sole proprietorships or under those structures as self-employed individuals, you're also eligible for this. And later in this presentation, we'll talk a little bit about the implications of that with your contractors. So if you have people who are on 1099, in many cases, they're not eligible for how you calculate this loan and how the forgiveness is calculated, because those 1099 employees are actually eligible for this same loan program. So we'll talk about that a little bit later. Okay, the other important piece here is for restaurants, there is a NAICS code, right, which is like how the government classifies what type of business you are in. And if your code starts with 72, i.e. it's a restaurant, then the way that your employee count is calculated is different than for everyone else. It's calculated as a function of each location as opposed to the business as a whole. So many of you may have multiple chains, or you may have multiple locations. And so each of those locations qualifies for its own loan. So you'd actually apply for them all separately. The last piece here is, employees include all individuals who are salaried, who are full-time, who are part-time, or any other basis, but it does not include contractors who are 1099 employees in terms of how you calculate the number of employees that you have. Okay, last couple of points here. The number of employees is going to be determined by taking the average over the last 12 months. So some of us have had, the employee count fluctuate. Sometimes things are seasonal, sometimes you're just making changes. So in general, you're going to look at the average over those last 12 months. If you're a seasonal business, then the government's going to let you use your average payroll from February 15th of 2019 to June 30th of 2019. And so what I would encourage you to do is go and look at your payroll, see which is going to give you the larger number. So if you look at that 4-month period from February to June, if that's a bigger number than looking over the last 12 months as a whole, then I would encourage you to use that number. Most restaurants can make the argument that their businesses are seasonal, certainly on a weekly or monthly basis. So I would encourage you to look at that. A couple other things here. Let's see here.
I have a quick question.
Yeah, please.
So we have Frankie, whose restaurant is listed under an LLC with 2 owners but 15 employees. Are they still eligible?
Yeah, so they're not going to have a problem at all. So going through the application process, the SBA is going to require you to disclose anyone who has 20% interest in the business or more. So if you and your partner are 50-50, then each of you will need to provide your information to the SBA. Only one of you needs to sign off on the documents, but they will need to know who is a benefactor of the loan or of the business. And so again, it's just anyone who's over 20%, but an LLC is fine. Structurally, there's no issues there.
Great, thanks.
Yeah, no problems. So other things that have changed from the traditional SBA process, you don't have to demonstrate that you couldn't get a loan or credit elsewhere. So traditionally, the SBA would say, hey, look, we'll loan you this money if your bank won't do it or if you don't have any other option. That clause has basically been removed under the CARES Act. So you don't have to demonstrate that you could get funds elsewhere. You also do not have to pledge any sort of personal assets. So again, traditionally in the 7A program, you needed to put up some type of collateral. Maybe it was your building, maybe it was your home or something along those lines. But in this case, there is no personal asset requirement. Let's see here. Okay. Okay, so to Frankie's point, there is a clause in the CARES Act that's called the affiliation rule. And this is basically put in place to keep the subsidiaries of large corporations from being eligible for this CARES program. And so basically what it's asking or what it's trying to test for is your business materially controlled by someone else? And if you're a corporation, this is going to be in your charter, typically, like who represents your board, who's on your board, and what is the interest of each of those parties. For people who are in LLCs, it's simply going to be your articles of incorporation and looking at who, again, are the benefactors for that business. And so as long as they have below 20% interest in the company, they're not even necessary to complete the application process. If they have more than 20% or if they have control of the business, then you may need to be concerned about the affiliation rule. The reason why this is potentially relevant for some companies and not for others is if you have a major investor in your business, they're over 20%, let's say, and they have multiple investments across multiple companies or businesses, the way that the SBA will calculate the employee count is actually the employees of each one of those companies that they've invested in combined. So that runs the risk of it being over 500 employees. And that's the thing you need to watch out for with the affiliation rule. We've put some references in here if you want to just look at some great tests for how you can figure out whether or not the affiliation rule applies to you. In most cases, it doesn't, unless you have, again, major investors who have over 50% or control effectively of your business. This is not really going to apply for vast majority of companies. And this is, it's just an example of how the employee count will be calculated using sort of the affiliate clause and so on. Okay, now the good stuff, maximum loan amount. So as we mentioned before, the max is going to be $10 million, and effectively you're eligible for the lesser of 2 options. So one option is 2.5 times your monthly payroll, and then the second obviously is a $10 million cap. So the way that the 2.5 times your payroll is calculated, it is going to be either the average of your last 12 months, or as we mentioned earlier, if it's a seasonal business, then you're able to take a specific window, which is from February 15th to June 30th of last year, or from March 1st to June 30th of last year, depending again on which number is larger for you. There is no stipulation on what is a seasonal business and what's not. It's actually your own certification. So if you think you're a seasonal business, then you are. If you don't think you're a seasonal business, then apply accordingly. But again, our recommendation is, look at what numbers are the biggest, and that's going to just increase your eligibility. And you certainly don't have to take all of the capital that you are eligible for. And then if you were not in operation during that time window last year, then it's simply going to take the trailing months from now. Okay, so let's talk a little bit about the definition of the payroll cost, so how it's being calculated. So the first part that's important to remember is that only salaries that are below $100,000 are going to be counted. Now, it doesn't exempt the people who are making over $100,000, but what it will do is only count up to 100 grand for each employee. So if you had, let's say, 2 employees, then the maximum payroll that you would be able to count from an annualized basis would be $200,000. So that's just something to be aware of. The same thing is true actually on the forgiveness side as well, that any funds used to pay an employee that's over $100,000, it's not going to be forgiven for the amount above the 100K. So again, it'll forgive everything up to 100,000, but anything above that will not be forgivable. So it's just important to keep that in mind. It's going to include cash, includes all the equivalents. It includes benefits, your payments for vacation, parental, family, medical, sick leave, all of those elements as well. Also provides the clause for separation or severance that you pay out, anything along those lines. All of your retirement benefits, your healthcare benefits, and your payment of state or local payroll taxes. Now, this actually just changed, and so we'll make an update to this. So the Treasury released guidance on Sunday that said they are now actually including the federal payroll tax. So that's going to be part of this calculation. So all of the calculators that we created, and as well as the ones on Gusto and Rippling, are going to reflect that. But it's just something to take note of. And there's actually another bullet on that at the end of this presentation. Let's see here. Okay, any questions on that piece of it, or are we good to move on?
Yeah, we're good to move on.
Okay, perfect. Okay, so permissible uses of the loan proceeds. So when you do the loan application, they're actually going to ask you, how are you going to use the funds? And it's a little bit of a trick question, because the bill itself states that you can't use more than 25% of the loan amount for things other than payroll. So what we've, again, sort of recommended is that you basically use it all for payroll, or at least submit a plan that you're going to use all of those funds for payroll costs. Now, when it comes to loan forgiveness, there's a similar stipulation, right? So that the maximum amount of the loan that you can use for non-payroll costs is going to be 25% if you want the loan forgiveness. So it's important to just sort of keep that in mind. But other things that you could use it for if the need arises. Anything related to benefits, sick leave, medical, family leave, insurance premiums, so on, salaries, commissions, any type of compensation along those lines. Payment of interest, but not the principal, right? So if you own a building, or if you're working out of your own kitchen or commissary, or even working out of your own home office, the interest associated with your loans is something that you can apply these funds towards, but the principal does not, right? So just to be careful of that. What's going to happen from, what's going to happen from an administration standpoint is when you apply for the loan and it's granted, they're actually going to deposit the funds into an account with that bank. And then they're going to ask you to pay these expenses out of that bank account. And that's actually how they're going to use the bank account to certify whether or not you're applying these funds to the right categories. So just something to be cognizant of. This is part of the reason why we've seen banks give a really high preference to clients who have existing accounts with them already. It makes it easier for them to administer. If you don't have an existing account, they're going to make you create one so that they can administer this like guidance. One last point to make along those lines. In this bill, the government did not create what we call a safe harbor rule or a safe harbor law. And what that would have done is it would have indemnified the banks against any sort of recourse if the loans turned out to be fraudulent or issued sort of incorrectly or erroneously. So the banks are a little bit sensitive right now, because if they issue the loan and it turns out that the person shouldn't have gotten it, or it was spent on things they shouldn't have, then the bank is 100% accountable. The government's not taking any responsibility for that. And so you're seeing the banks be a little bit squeamish about trying to get people through the process, trying to mainly focus on people they have existing relationships with, and so on. So it's going to take some time to work through that. One other point there is with Wells Fargo, they have a little bit of an issue because of some of the credit card challenges they had before, right, where they were opening accounts on people's behalf and they sort of got punished. What that meant was that the government is not buying debt from Wells Fargo. They're making Wells Fargo hold all of that debt within their own bank. So Wells Fargo has a limit on how much they can lend. And I think they've already reached that limit. So if you bank with Wells Fargo, you're probably going to have to apply somewhere else based on what we're seeing. Okay, last couple of points on this page. Interest on debt obligations that were incurred before the covered period, you can apply funds towards that. So if you've got an outstanding line of credit, you've got other loans, you have automobiles that you've leased, you can pay the debt obligations, the interest on those debt obligations using these funds, and that will all be part of this program. You can use it there. This last part that's really interesting, there were two programs that are running concurrently. So one program that existed before the CARES Act, which is called EIDL. This is the Economic Injury and Disaster Loan. So originally this was created for, like if a hurricane hit your area where there was a big flood, then you could go to the SBA and you could borrow money to continue your business. And this loan would have maybe a 20-year or 30-year timeline and sort of a favorable interest rate, something that's like 3.5 to like maybe 4%. And so that program has been around since 1979, and it hasn't really changed, and that program's still available. And so one of the things you may be hearing is people who are applying for EIDL and people who are applying for the PPP program. So one of the nice things about the PPP program is that if you have an EIDL loan, you can actually use the PPP, those proceeds to pay down that EIDL loan. However, you cannot apply for EIDL if you have PPP, right? So they're going to factor that into your EIDL loan, basically. So if you think that you need more capital and you want to pledge personal assets and you go through that SBA program, that process, then EIDL might be a good option for you. And then you can apply for the PPP program and use those funds against your EIDL, right, to pay down that loan. And if you use it for things like payroll, employee salaries, rent, utilities, so on, then it's going to be forgivable, right? So effectively free money, it turns into a grant. Okay, so let's talk a little bit about the criteria for loan forgiveness. So the CARES Act provides that all or a portion of this loan can be forgiven. And the amount that's forgiven is going to be a function of what you spend it on, right? So if you spend 100% of it on payroll costs, then 100% of it is going to be forgiven, assuming that you've met these criteria about how much each employee is being paid and like what your overall head count is and so on. Again, mortgage interest but not principal is going to allow you to write off or effectively be forgiven for that amount. Rent, for any sort of lease that was signed prior to February 15th, you're going to be able to use these funds to pay that rent. Utilities, all of those types of things. Now, the amount that is forgivable, it can be reduced depending on what your head count is. And so if there are pays to employee cuts or cuts to employee headcount, then the PPP forgiveness is going to calculate the ratio of people that are gone relative to the people you had prior to the loan being issued. And then they're going to reduce your forgiveness by that amount. So the idea here is the government's trying to get you to keep as many people on payroll as possible. Effectively, they've said, look, if people are laid off or furloughed, then they're going to have to go on to unemployment, and we're going to have to basically pay to help them have a minimum wage anyway. So we might as well give these funds to small businesses to let them pay these workers and keep them on payroll, so that when we are able to address coronavirus, we can climb out of this as quickly as possible. And so if people take the cash, but then they still let all the employees go, it doesn't really serve the benefit the government's trying to create. So, again, for us, we want to encourage you to make good business decisions, right? So it doesn't do you any good to make poor business decisions, but get capital that, has a low interest rate. In the end, ultimately, this is going to work out one way or another. And so to the extent that you can accomplish both things of both keeping people on that are necessary for your team and helping you build the business, and make it forgivable, and that's the best of both worlds. But we don't want you to make bad decisions or poor decisions just to have this money forgiven. Okay, let's see here. The last 2 points here. The interest on forgiven principal, it's also forgiven, right? So typically when loans are forgiven, the government says, hey, that's income. You need to pay me taxes on that. All of that has been removed from the CARES Act, or in the CARES Act. So you won't be, you won't be liable for the funds that are forgiven. In addition, the debt itself is not going to be a taxable income for you. So once it's forgiven, you're done. And you can move on with your business, and you don't have any other obligations associated with it.
Got it. If some of the funds are used for rent or utilities, does it have to be under 25%?
It does. So yeah, the Treasury, they didn't originally stipulate it in the bill, but then they came out and changed the guidance on it. Yeah, and actually I think you can see it right here. That basically they said, look, because the primary focus of this is to keep employment high, and there's so much demand for this cash, we really want it to go to these things that are related to payroll. So they are not going to be forgiving, for things that are above that 25% mark that are non-payroll related.
Got it.
Yeah. Okay. And then one other point I just wanted to highlight here, forgiveness is not going to be permitted unless the business can produce, documentation. The onus for this lies on the banks themselves. So this is why I was saying the process that we've seen with Chase, with Bank of America, and with Wells is they're basically going to say, hey, here's a bank account. We're going to put all this money in here, and then we're going to track how that money leaves that bank account. And here's how we're going to track this process for you. You will still need to apply to the Treasury Department to say, I'd like this loan to be forgiven. It will not be forgiven automatically. And I believe you have, you have 2 years. You have 2 years to complete that process of asking for that forgiveness, but you do need to, ask for that forgiveness in order for it to happen. Okay. So then let's talk about some of the limits on the loan forgiveness. We talked about the 25%, rule for, non-payroll related things. The forgivable portion of the PPP, it's going to be a function of the head count of what you retain. And so if you look at this second clause here, second bullet point, the ratio is again going to be the average number of full-time equivalent employees per month employed during the covered period, right, which is the period after the loan has been issued, divided by the number of heads that you had prior to the loan being issued. So that's an easy way for you to be able to calculate what's going on there. They don't necessarily have to make the exact same salary that they were making before, but the guidance that the Labor Department is giving right now is that the salary needs to be within 20% of what it was prior to receiving the loan. The covered period is an 8-week period beginning the date that the loan is issued to you. So in effect, the government wants to get this money out as quickly as possible, and so they're incentivizing you to spend it as quickly as you can. So they're giving you 8 weeks from the moment the loan is issued to spend it. And if you spend it on payroll or these other sort of eligible expenses, then the whole thing is forgiven. If you spend the money on sort of 8 weeks in 1 day or 9 weeks, then those funds would not be forgiven, just to be clear. So you do need to spend it within that 8-week window. Now, the loan itself, if you're not eligible for any of the sort of forgiveness, right, if you don't end up using it for any of those purposes, the loan itself is being issued at 1%. So if nothing else, it's still a really low interest loan. And it has an expiration of 2 years. So you get this very low interest loan for 2 years. And you can use that for however you want to use it at that point, but it's not going to be forgiven.
Got it. If the restaurant is currently closed, can the owner apply the loan to help the reopening of the restaurant, or does the business have to be open the entire time?
No, the business does not have to be open the whole time. And it's actually the last bullet point on this page. This is page 12 here. So if you lay off workers and you furlough and you sort of got to shut down the business temporarily here, um, you have 8 weeks from when that loan is issued to basically bring on, equivalent number of people or as many as you want, reopen the business and get them going and so on. Honestly, even if you don't reopen the business, as long as you're paying people with these funds, then it will be forgivable. So you don't actually have to open up and operate technically. Now, if you're paying people, it's probably work that you have them, that you got that you want them to do, and maybe there's some planning and things. And we've been working with lots of partners to help them just sort of develop their operations and develop their online strategies and connect their applications like in this sort of downtime, because demand is reduced, right? So we're not seeing a ton of demand, and so you may not necessarily have work for people in the traditional sense, but as long as you're using these funds to pay them, you don't have to be open and operating. You just need to use it to pay those people.
Great, thank you.
Yeah, no worries. Let's see here. We talked about calculating on the loan forgiveness, so I think we covered all of those points. Okay, great. Key loan terms. So we covered some of this. The loan itself is 2 years. It's at 1%. The original guidance was 0.5%. The Treasury came out and said, look, the demand is through the roof. We think people can pay 1%. It's still really, really low interest loan. Some people might remember sort of the late 1980s, early 1990s, where interest rates, at the LIBOR level were 17, 18%. So I mean, we've never seen cash this cheap, which is why I encourage as many people as possible who are eligible to apply for this. Reiterating, there is no personal guarantee. There's no collateral required. You don't want to not pay the loans back. I think we've had some questions of people saying like, well, what's the recourse? The government will not come after you on these loans in terms of your personal assets, right? But what will happen though, is it will largely make you ineligible for SBA loans in the future. And it may be something that they take from you or apply against you as it relates to your business's tax returns. So in the future, if you're eligible for a refund on, let's say 5 years from now or 3 years from now, you're eligible for a refund on your business taxes, but you never paid back this loan, the government's actually going to take the money out of your refund. That would be the primary way that they would reclaim these funds if they're not paid back. So you do want to be cautious of that. It may also show up on your credit, not your personal credit, but your business's credit. So, we would encourage people to pay the loan back. It's just general good principles, I think, here as well. As far as fees, the SBA is not going to charge a fee related to this. So if you have a bank or you have people who are coming out of the woodworks, they're saying, hey, I will do this for you or I'll help you with this process, but we're going to charge you a fee. Those people are probably fraudulent. So I'd be very cautious of that. Really, if they're not an accredited lender, if they're not a bank, then they probably don't have access to be able to lend you these funds. The process itself, we've given some good pointers in here. There's some others on the next page that should help you get through the process pretty quickly. We've done, I think 4 times or 5 times at this point. So we got a pretty good sense of what the process looks like, at least for a handful of banks here. So you should be able to get through this with no problem. Last part on this page, there's no prepayment penalty. So take the cash. If you don't need it, you can always just pay it back. The interest is 1% a year. So for every $100,000 that you borrow, you're on the hook for about $8 every month that you keep the cash for. So, there's really no reason not to take the money if you're eligible for it. You can always prepay it. There's no penalty. Okay, let's just talk for a quick second about interactions with the other parts of the CARES Act. So as I mentioned earlier, the CARES Act, 800 pages long, it's 806 pages long now. There's a lot in it, and some of the elements of it interplay. So some of the other programs that are in the, other programs that are in the CARES Act that might make you ineligible for the PPP program or vice versa. I just want to call those out here so that you're aware of those. So the Act created a credit against the federal payroll taxes, and it's equal to 50% of the qualified wages paid to each employee. So basically the government's saying, hey, look, if you want, rather than taking the PPP program, we'll suspend your need to pay federal payroll taxes until the end of the year, right? So you don't have to pay any federal payroll taxes, and then we'll basically allow you to pay those back to us over the next 2 years, right? So by 2022, you would need to pay those back, and they would just kind of add a little bit more to your payroll each time over sort of the years 2021 and 2022. If you decide that you want to take that program, the federal payroll tax program, it would make you ineligible for the Triple P program, and vice versa. So you have to pick one or the other. So it may make sense for you to calculate, hey, what is my payroll going to look like for the future, and take those funds accordingly from the program that makes sense. Sort of the rough calculation is, if you think that your labor force is going to be the same or larger than it was prior to the coronavirus sort of outbreak, then this program might be better for you. The federal payroll tax program might actually be more beneficial for you. Okay. The maximum qualified wage amount for employees is $10,000. And so you're not going to be able to exceed that, just to be aware of that. Let's see here. Yep, eligible employers must have operations fully or partially suspended. Almost all of the restaurants are going to be eligible for that, right? I don't think there's an argument that any sort of one in the restaurant or hospitality space has been unaffected by the coronavirus. Let's see here. And then we talked about gross receipts, the same calendar year and prior year. Absolutely. So, so again, you can have your choice of this program, or you can choose the Triple P program, but the government's trying to keep you from basically double dipping. Okay, last couple of points here. The payroll tax deferral. So this just gives you a little bit more detail about what I mentioned earlier. It's going to let you defer those payroll taxes until the end of this year, December 2020. And then 50% of those taxes are going to be due at the end of 2021, and the remaining 50% by 2022. So again, it's letting you stretch out your federal payroll taxes for another 2 years to give you a little more breathing room. Okay.
We have another question.
Yeah, sure.
If restaurant owners currently bank with Wells Fargo, is your recommendation to try to apply for this loan with another bank, or should they?
Yeah, you're gonna have to apply somewhere else. So Wells Fargo, actually, they sent out a notice Saturday, and I will forward it. Let me just make a note here. Yeah, so they sent out a note, and just the note said, look, we're limited in how much we can lend as a bank. So we're going to take companies that have less than 50 employees, and we're going to take companies that are nonprofits. And as of, I think, Sunday, they had filled up their allocation of like what they could possibly process. And just to give you a little bit more color on it, basically what happened was that typically when a bank issues loans, they don't keep it on their own books, right? Because they only have so much cash to lend out. And so they're in the business of getting the loans, originating it, they package them all up, and then they sell them to the government, or they sell them to the stock market. Well, in Wells Fargo's case, they had a bunch of accounts that they created, this is sort of last year or 2 years ago, that were fraudulent. They created these accounts they shouldn't have, people didn't actually sign up for them or want them. And as part of the settlement and punishment, the government said, hey, look, we're not going to buy any more of your debt. So whatever you guys, like, we can't trust it anymore. So whatever you guys issue, you've got to be on the hook for it, because we're not taking it anymore. And then the public market said to Wells Fargo, well, yeah, we're not sure if you guys are above board either. So we're not going to pay you a really high premium for your debt. We're not going to give you we're not going to pay you a lot for it. We'll pay you very little. So that meant that Wells Fargo's business model of selling their debt basically got crushed. And so they only have a cap of about $10 billion that they can keep on their books at any given time. This is across auto loans, this is home loans, this is business loans, credit lines, everything, only about 10 billion. So as you can imagine, with the numbers that we're talking about with the CARES Act and the relative size of Wells Fargo, they're just really hampered in how much they can lend. And so they've already hit that limit. So what they're encouraging people to do is basically go to any other bank. We'll share a link with all of the banks that are eligible to lend on behalf of this program in the SBA, to help make it a little easier for you to find. And there's about 1,800 of them, so you should be able to find one. If not, if you have trouble, let me know, and we will try and find somebody personally who can do it. because we have relationships with almost all the major banks here. Okay.
Great.
So just again, a little bit more just guidance on what business owners should be doing. Get familiar with the bill. I think this ebook does a good job of just laying out the major points to it. If you are really interested, you've got sort of 9 or 10 hours to kill. Go read the whole 800-page thing. There's lots of stuff in there about wills and estates and like the way that net operating losses are calculated, just like lots of craziness along those lines. I would encourage people to read that after they've gotten through this piece. So this is the more time-sensitive part. And we're happy to send out some more guides that will help you navigate some of those like personal finance pieces that the CARES Act is going to change and how taxes are calculated and that kind of thing. You want to calculate your payroll, figure out sort of roughly how much money you're going to be eligible for, and then also create a plan for how you're going to use those funds. So what you don't want to do is sort of the funds hit your account and then you start thinking about how you're going to use them. Just because the clock starts ticking almost immediately, right? You got that 8-week period to sort of spend it in order for it to be forgiven. So you want to make sure you have some idea of how you're going to use it. Gathering documentation. So things they're going to ask you for is your payroll stubs. So, for the time periods that you want to use for that payroll calculation, they're going to ask you for your EIN number for the business, not surprisingly. The social security numbers for anyone who owns 20% or more of the business or has sort of controlling interest in the business. You're going to need their contact information as well as their social security numbers. And then you're going to have to just answer some questions about how are you going to use the funds? Are you going to use it for payroll? Are you going to be forthright, pay the money back, like that type of thing? And the rest of it's pretty straightforward. And almost all of the process is electronic now. For the financials piece, we were not asked for the profit and loss balance sheet. I think it's good to have that in case you are asked for it. The process that we saw, people were being asked what was your income last year, like what was your net operating income of your business, and there was no sort of backup documentation requested. So if you just knew that number, if it's $250,000 or $500,000 or whatever the number was, simply putting that in there was sufficient. And then tax returns, your 941s, we were not asked for that either. So that may come later, maybe as the process evolves here, but I think they're just good documents to have on hand. Okay, other quick points, just evaluating which program you think you want to apply for. As I mentioned, the SBA's EIDL program, the Triple P program, as well as the federal payroll tax abatement, those all work against each other. So if you do one instead of the other, excuse me, if you do one, you're not going to be eligible for the other, except in the case of the EIDL, where you can use the Triple P, or sort of the payroll program, to pay down that EIDL loan, right? So just being conscious of that and making sure that you pick the program that's going to benefit you the most, and so on. And then applying as quickly as possible. As I mentioned, the first tranche of this has been $349 billion, $55 billion of it's already gone out as of Tuesday morning, yesterday morning. So you're going to have to imagine that there's probably something like 40 or 50 billion that's going out every day here. So by the end of this week, that initial tranche will probably be gone, but hopefully there'll be more that comes from the Treasury Department. So we might have some questions.
Yeah, so if the restaurant gets this loan and ends up using 50% on payroll and the other 50 for something else, will the other 50% be forgiven, or will it be all or nothing?
Yeah, it's not all or none. So what they will do is they will calculate the forgiveness as a function of what the eligible expenses you spent on. So in this example, if you spent 50% of it on payroll, then that piece would be forgiven. And if you spent 50% on non-eligible expenses, then that would be carried as a loan at 1% until the end of the term of that loan, which would be 2 years from the day it originates. Yeah, so that second 50%, if some of it's used for rent or some of it's used for mortgage or what have you, those would also be eligible, right? So you can use those expenses as well. But whichever eligible expenses that you spend the funds on are going to be forgiven. everything else gets carried as a loan moving forward.
Sounds good.
Okay. A couple just important tips, just having gone through this process a couple of times now with a couple of different banks, any dollar discrepancies are going to get the application kicked back. So because of the quantity of applications, they put a lot of sort of like fraud check systems in place that are causing them to reject a lot of applications for sort of silly reasons. So one of the more common ones we've seen is that typically your payroll is not an even dollar amount. It'll be, you know, $20,000 and like 7 cents or something along those lines. And so when you calculate the loan amount, it's typically people would multiply by 2.5, and they'll get, again, some dollar amount with cents. And so the two of those, if they don't match up to exactly 2.5 times your payroll, then the application gets rejected. And you get kind of pushed to the back of the line. So what we've been recommending for people and what we've seen work well is just round down, right? So if it's, you know, $2.98, then round it down to $2, multiply that by 2.5. And again, if that number comes out to, you know, a fraction or repeating decimal, then round down to the nearest dollar. And that'll get you through the process with no problem there. Second part, your NAICS code, right? So your national identification number for your business. This is not your EIN, but this is the classification of like what type of business you run. That needs to match your tax filing from your most recent year. So if you have your 1040 or you have any of those documents, it'll be on form 1140 of your taxes, and I'll add this just to our notes for a follow-up. It'll be on your 1140 ER. Right at the top of that form, it'll say, this is your NAICS number. So the application is going to ask you for that. You want to make sure it matches because it's, again, one of those fraud checks they're going to use. Zip codes. So again, another one of these weird fraud check things. They're using the 9-digit zip code. So most people were used to using the 5-1, but if you use it in places that they're looking for a 9, it will also get the application rejected and get pushed to the back of the line. So wherever possible, use the 9-digit. If you're doing it on paper, then it's easy, you just write it in. If you're doing it electronically, it'll tell you, it'll say, hey, you need a 9-digit code. We did not include the link to the USPS. Let me add that as well. So the USPS, the Postal Service, they have a website that you can put in your address. It'll spit out the 9-digit code. So that will help you make sure you use that code to get through the process. Independent contractors, excuse me, as we mentioned, those can't be used in the calculation of your average payroll. So if you've got people that you're paying, if you've got, you know, people who are undocumented or, you know, something along those lines, like, you can't use those in this calculation, and they will check for it. So it's just something to be aware of. They're actually eligible for their own PPP benefits, right? So they can actually apply for this program themselves as independent contractors, really effectively really small businesses. So that's why they're not eligible in this calculation. And then, as I mentioned earlier, the payroll calculation as of Sunday now includes the federal taxes for your payroll. So it was unclear whether or not it included that basically until Sunday, but the Treasury Department and the Department of Labor cleared that up on Sunday. And then we added some links here to the bottom. If you're using Gusto, if you're using Rippling, or like some of those popular payroll providers, you're going to be able to use those links to calculate your loan amounts pretty easily and sort of spit out a payroll report that you can submit with your application. That'll make life easier. And with that, we can take sort of any remaining questions and let people get on with their days.
Yeah, if you'd like to unmute yourself or raise your hand, if you have any questions. If you don't have any questions, you can feel free to email us later with them. You can reach us at either info@Eatgeek, food@Eatgeek, which is my email. Or if you want to reach out to Collin directly, you can reach out to him at Collin with 2 L's at eatgeek.com. If we don't have any questions, I'd just like to thank again everyone who attended our webinar today. I know how precious your time is, and we hope that this helped clarify any of the CARES Act and help you with your business loan. We'll be following up again with all the links to the resources that we mentioned here. We'll have the calculator available for you to calculate your loan amount, and we'll also be sending out a link with the recap and the session for this webinar. Great. If you have anything else, if you'd like to leave your comments or feedback, we'd be happy to hear about what you've learned, what we can improve on our next conversation, and topics you'd like to hear about next. And with that said, thank you again, everyone. Have a good day.
All right. Thanks, everybody. All right. Have a good one. Hang in there.
Thanks, guys.
Right.
Thanks, Collin.
Thank you, everyone.
Bye.